Hello and welcome to the March edition of the monthly market update. My name is Janelle and as always I'm joined by Simon. We are a bit late because Simon was dying last week.
Proper dying. I went to bed, I was so dying.
But he is back alive, kicking, not dying. And we've got quite a lot to get through, and we figured because it's already a bit into March and a lot has happened already, we're going to cover a bit of what happened in February, but we're also going to focus on some of the very interesting and fascinating things that have happened in March on the stock market. We've had a lot of shares doing some really fascinating things, hitting some lows that were last seen in the early pre-2010, 2012.
So someone chirped that, I think it was Tongard, was at the levels when they were at school. I'm like, okay, so no, it turns out they weren't that old.
So yeah, it's been Tongard, it's been Aspen, it's been MTN. We've seen some very interesting moves from those companies. But we're also going to start perhaps with resources, which in February were the best performing sector. And Implats and Amplats up about 56 and 20% respectively.
Yeah, so I mean, resources were the sector of last year, and whilst we've had a green start to the year, and in fact globally the best start to a year since 1987, it's been driven by resources. The platinum stocks, if you go back to their lows of last year, have tripled. I think Implats is up 300% from the lows. And the story is quite simple. We look at platinum, and platinum we know is stuck in the 800s. But palladium and rhodium, the other in the basket of PGM metals, PGMs, has done incredibly well. They're benefiting from that. But they've also really moved themselves down the cost curve. And particularly in the Anglo-American stables. So if we look at Minas Ria, but to a much lesser degree, but certainly Kumba Iron Ore, Anglo Platinum, De Beers not, because they're in a sort of specialized niche. They've closed the expensive mines. They've just said not interested. They've closed expensive shafts. They've moved down that cost curve to produce platinum cheaper. Now, when the platinum price is $2,000, you mine whatever you can, and you get lazy in a sense, and you don't, costs can rise. That's fine. The price is working with you. What they've very, very efficiently done is managed to work their way down that cost curve, and therefore make profits at these levels, and get rid of debt on the balance sheet. Our miners, and let's put the gold miners aside perhaps, but the miners generally, and particularly are diversified locally and globally, probably have got the strongest looking balance sheets since forever. And particularly if we go back 10 years ago, just post the crisis, where they were riddled with debt and unprofitable assets and the like, and they've absolutely turned them around. Mark Cutifani at Anglo has done an astounding job. Billiton, same sort of story. So they're benefiting from that, and they're benefiting from commodity prices. So there's been an uptick in iron ore because of the Vale story. That will be temporary. But they've certainly benefited from fixing the businesses, seeing commodities go their way. And the last little bit that's helped is reports coming out that it looks like there will be trade peace in our time, that Trump and China will come to some sort of agreement. And that's always been my sense. Now, I hear your skepticism, but it's very much how Trump works, right? Lots of shouting and bullying and everything, and then eventually a deal which is not that much different from what was in place, but it gives him a space to trumpet it as
a victory.
As a victory. And my sense is that we will get some level of trade peace in our time, and that, the deadline has passed. That was 1st of March, but they've extended that. And that's good for commodities. The negative is that data coming out of China suggests that that GDP growth is slowing, and that maybe the data wasn't so reliable. Truthfully, no one 100% trusted the data, and GDP might be slowing, but if you're doing 6% as the second biggest economy in the world,
you're doing pretty well.
You're doing fine.
Especially considering that the biggest economy isn't doing so.
Yeah, the US did 2.9, which is a good number. You're the biggest economy, 2.9 is a brilliant number. Problem is it was the year of the tax cut. I would have expected, frankly, a lot more than 2.9, because that tax cut was the supposed initial year. Now we've got the base effect, so for 2019 it's different. I frankly would have expected more than 2.9. It's not bad for the largest economy, and frankly, we're struggling to do 0.29.
We can't. We can't get there. Okay, and you touched on the gold price, and I just wanted to actually pick your brain on how do you think Eskom wanting to hike up their prices is going to affect particularly the gold miners. Sibanya's already started to express some concerns around that. And, as investors, what do we need to look for?
Yeah, so I mean, the first caveat is that whenever companies talk about something and press releases or whatever, if it's good, it's making jobs, and if it's evil, it's going to hurt jobs. So if you don't like something, you say it's going to lose jobs. But our gold mining, and I parked gold aside because our gold mines, we've been mining gold for 140 years in this country. We have pulled out literally tons and tons. For about 125 of those 140 years, we were the biggest producers of gold in the world. We still have vast amount, but it's deep. The head grades aren't, so grams per ton are down, whereas the platinum guys are starting to go deep. A deep platinum mine in the gold, man, you're still warming up. I mean, you're not even. So the platinum miners are going deeper. Iron ore is mostly surface. Coal is mostly surface or close to surface. The gold mines are really, really deep, and it's a factor of we've taken all the easy stuff. Of course we have.
Yeah.
And it means that we're now sort of fourth or fifth in terms of gold production. And there's lots of things we can blame, but it's harder and harder and therefore more expensive to get the gold out of the ground. Gold at its current prices of around 1,300 is not inflation adjusted for anything. If you look at the peak in the 80s at 850, if you look at it trading at 1,800 when the US got downgraded in 2011, I think it was August 2011, and just to stress, they got downgraded to AAA as opposed to AAA plus.
No, not our version of downgrade.
Gold has just not performed. It hasn't kept up with anything, which means the costs are rising, and those costs are predominantly going to be labor and electricity. And labor, been going ahead of inflation, and electricity ahead of inflation. The gold mining space in this country is on its knees. I don't know how we save it. Mechanization is not the answer, not at those sort of depths. And truthfully, there might be a time when we just no longer mine gold as a country, just because, you've got the DRDs who's sort of mining the mine dumps and the like and doing some work there, yes. But in terms of actually extracting from the ground, even Pan-African, who's redoing some of the Barberton mines, and Evander are finding it immensely tough. If gold was $3,000 an ounce, sure, different story. But I don't know what's going to drive it to $3,000. So to me, your first prize is always to buy diversified commodity companies. If the commodity is booming, buy the direct, and just stay away from gold as a rule.
Okay, and perhaps let's turn our attention to telecoms because actually, let's do retail. No, let's do telecoms. We'll leave the best for last. Telecoms down 8.3% in March, in February. Obviously, MTN being There's a lot going on. We had Nigeria before, and now it's Iranian ops, all sorts of scandals coming up, and it's just scandal after scandal after scandal. Where does it end? Their earnings in Nigeria seem to have done very well, but that has done little to give the market some assurance that things are going well.
Yeah, I mean, post-Feb month end, there was the MTN results. The market liked them. They weren't bad. Telcos themselves have been under pressure. Even Telkom, which has been a star performer, has seen its share price come back a bit. And that's probably that the share price probably was somewhat stretched. Vodacom been under pressure as well. And I mean, there are a couple of moving parts. One is we're moving into 5G, which will start appearing in a few places in sort of Europe and North America towards the end of this year. We're doing some test sites, but it'll be a couple of years before we have. But that's going to cost a fortune. Now and that's the challenge with these telcos is CapEx. Now maybe they can get clever, and there's been talk about it, and I know people don't like it, and even the US is talking about it. But in essence, almost a nationalized network, because otherwise you've got 5 towers all next to each other, all doing the same thing, all operating at a certain capacity. Why not one tower, which you all
5 providers,
and you all just rent space from it and the like? And maybe capacity issues, you need to have them closer. Part of 5G is that the range is incredibly small, so you need lots of them. So they're coming up. They always spend hugely on capex. That capex spending is returning en masse.
Yes.
The other trick is if we delve around. I mean, if we look down at Cell C, really bad results. They spent 1 billion ZAR on their Black initiative. buying content and have probably not made a fraction of that back. But we've spoken before about ultimately what are these telcos? They're utilities. They're selling us data, and prices kicking and screaming are coming down, but slowly and will continue to do so. And my contract's up, and I know very much what I want. I want a couple of voice minutes, I want a lot of data, and I want to pay a very, very small amount. If you go to the traditional MTN and Vodacoms, it's very difficult. They insist that I take 500 SMSs.
And you're like, who sends SMSs?
I don't know when last I sent an SMS. I mean, I really don't. And it's that flexibility and what you really want. And oddly enough, Telkom's got the package, 20 gigs of data, 1,500 minutes, and 500 Rand. No device, but so I think there's concerns around that. In terms of MTN, Nigeria working again, South Africa doing okay, issues around Turkcell popping up again, Iran popping up again. Whether the smoke is fire, we don't know. But when you're working in those sort of developing, emerging markets, there's going to be accusations and there's going to be uncertainties in some places. And it's a sector that I stayed well away from ever since the first Nigerian story broke. And at that point, the day before, MTN had been north of 200.
And now
south of 90.
70s.
Yeah.
So a very interesting
it's
story
a tough space. And what is your edge? I mean, your edge is, what is your edge? I mean, so network is important, but data's data. And right now, I'm agnostic. I will move to, I'll probably go to AfriHost, which happens to be MTN. But to me, it's a case of I can get the package that I want on a quality network in the areas that I need it. The network in Rustenburg is of no concern to me. I don't go to Rustenburg.
Yeah, but
then it's bang for buck.
Yeah. And then now we're going to move to the retailers, and a lot. So February down 9.4%, but also I think March, as far as into it as we are, has been a bit shaky. And perhaps let's first touch on Truworths, which was drop-kicked, or just kicked, out of the top 40 by Multichoice.
By Multichoice, so that was end of Feb, 27th and Feb, Multichoice listed. And the way the process the JSE did, and they do some flack for it, but if you're unbundled, every index that the stock you're unbundled from, you go into that index in the immediate. So on that Wednesday, Multichoice goes into all of the indices that NASPAS is in. And that makes perfect sense. Otherwise, it becomes a nightmare for the trackers.
Yeah.
And then they wait 2 days and they see, and it was fine. Multichoice made it. So on the Friday, 1st of March, Multichoice stays in the indices, which it's A, big enough for, and B, which it's relevant to, because that's not always the case.
Yeah.
So Truworths dropped out.
Yes.
They had there was only really two retailers who brought out results of note, the Fishini Group and Clicks.
Because
Everyone else was ugly, and Truworths was ugly at the same time. And you talk about 9.4 down in February, and they were down for January as well. And we've seen the results coming through, and we're seeing today AVI, which gives us sort of a semblance of an indication. Tiger Brands will be coming in a couple of months. And we know this, the consumer is under pressure. The electricity increases aren't going to help that. The fuel price increases aren't going to help that. We're getting positive GDP growth, but it is very, very modest. There were some glimmers, and particularly the ShopRite ones, which in January issued a first update, which was fine, and then a more detailed update, and the market went absolutely crazy. But their operating margin stayed at 4.4, down from 5.4, which still double what Pick n Pay does. I thought it might drop into the low 3%. And there's some things which you manage, which are, in the case of ShopRite, Mr. Price, Woolies, which they get wrong, which is their fault. And Mr. Price and Woolies, wrong fashion lines, ShopRite, distribution center strikes, and IT integration problems. And then there's some that are beyond your control. Consumer under pressure, hyperinflation in Angola, zero inflation in the food space. And you've got to say, look, those will come right in time. Angola will stop having hyperinflation. We'll start seeing food inflation coming through. Do you trust management to fix the others? And with some management, Mr. Price and ShopRite, yes. Woolies, I'm not sure that Woolies has ever got clothing to work. I mean, maybe there has been a flash here and there, but generally it's been a difficult many years for Woolies to get their clothing right. Truworths struggling from the same. And of course the saving of Edcon, which whilst that is mixed news for property stocks, great news for South Africa, 30,000+ jobs being saved is critically important. It does keep a large competitor in business, and a large competitor who's going to be aggressive to try and stay in business, which means particularly in the clothing space, it's going to be tough.
So everybody needs to be on their best game.
Yeah, and it's going to boil down to the quality management, and those are traditionally Foschini, Mr. Price, and ShopRite being it. Interestingly, sorry, and you mentioned it before we started recording, and I see David Neal from Clicks, ex-CEO, joining Woolies on the board.
Yes.
They had two of the Australian board members, one who was South African, quit suddenly. Certainly, Clicks is an amazing story. I dislike the stores intently, but that's fine. I'm not the
that's
market.
A personal thing.
Yeah, I'm not the market. You know what? It patently works. But when you look at a Clicks set of results, and you can go back 10, 12, maybe even 14 years, and what do you see? You see operational leverage across the whole business. What I mean by that is revenue up, say, 10%, profit up 15%, dividend up 20%. In other words, the numbers scaling upward rather than downward. And that just shows incredible efficiencies of operations, of management, of systems, of processes. And I mean, as a non-executive director, how much can he really do at Woolies? Time will tell, but Woolies has some serious problems in Australia, in their clothing. I mean, really just their food that continues to do well. And any level of expertise is really going to be useful.
Yeah, especially if you were previously running a great company.
Yeah,
which David Neal did.
He absolutely did. And I mean, when he arrived about 15 years ago, and they just bought Musica, which indicated a lack of clever strategy and the like, and he made it work. He turned Clicks into one of the best investments over the last 15 years. I think it's up 20-fold, including dividends from when he joined the business. So certainly he's got some level of skill, and this is the hard part, to separate. He's left Clicks. Does that mean Clicks is no longer great? Well, hopefully he's left some institutional knowledge behind.
Yes.
Ditto with Wati Basson at ShopRite and the like. So you can leave some institutional knowledge and systems and processes so that the company you're leaving doesn't collapse in a heap. That's not always the case, but certainly that is possible.
We hope so.
And you would expect from someone such as David Neal, that's exactly what he's done. That's what part of being a brilliant manager is leaving some institutional knowledge behind, being able to go to a Woolies, and even as a non-exec director, actually being able to have a positive impact. That all said, Woolies is not better this year. It's going to take a lot of process to turn it around.
Okay, and now to touch on something that really is a March story, but still very important. And I remember checking Twitter, and I saw the first tweet was Aspen opens at 11:18. And then about 5 seconds later, there was another one. And, I progressively saw Bright Khumalo from Vestact actually having a meltdown over the Aspen share price. And then not too long after that, Petrie came in. And it was just then a whole lot of the traders that I follow collectively just having a meltdown over Aspen, which touched almost like low 70s, and then rebounded
70s.
quite quickly, because by the end of the day it was above 90.
It closed just over 100 and some cents, and was down 20% on the day, which
is still quite
So there's three things I want to touch on here. First is there's a new phenomenon that we're seeing, and I think we've touched on it in this podcast before, which is back in the day. I remember, we're going now back to 2003, and Sasol put out a trading update, and this was before you were required to put out a trading update, and they called it a profit warning, which like they shouldn't have called it a profit. I mean, it was a profit warning. I mean, it was, but like.
But that's like panic mode.
But the whole sense thing was fairly new, and there were no, the obligations hadn't. Anyway, they did, and the market panicked, and the stock closed down 8%. What we see now, I mean, Aspen was down almost 50%, and we're seeing the Americanization of our market, where when something happens in the US, I mean, Boeing after the Ethiopia disaster yesterday, Ethiopian Airlines tragedy,
it was a disaster.
And Boeing in pre-market was down like a 1.28%. That is starting to happen in our market. Whereas if you disappoint, you get slammed. The inverse is that if you delight, you not as much, but you get a lot more upside to it. So we're getting a lot more volatility coming through. I don't like it, but it does create opportunity. If you think that Aspen was the best thing ever, well, you could pick it up at $70, which
it's not great.
Yeah. So well, hold your thought on that.
Would have been great on the day.
So that's the volatility, and we've seen that across the board in our market, Tongaat, just everywhere these days. But there's another angle to it as well, which is Aspen in particular, and a couple of points to it. So the thought is, so when they came the last results, and they're sitting at about 130, 140, PE around about 11, for a company where they're expecting revenue to grow 1 to 4%, not giving HEPS guidance, is not unreasonable. The question is, do you buy, or is there too much unknown? And in the case of Aspen, it was a case of let's rather wait for results. Sometimes you will buy ahead of, because you've got some confidence. Sasol results coming out, I was buying ahead of. There were some surprises around delays on Lake Charles, but broadly relatively small, and we had a good sense of what that results would be from Sasol. In the case of ShopRite, there was uncertainty, so I was being very careful. So I bought some more ShopRites, but I paid $175 instead of $145. Yeah, I paid a whole lot more. But the flip is Aspen, where you could have paid $140 and then suddenly it was $70 and now it's $100. Sometimes you look at it and you say, I like it, but I need more confidence, I need more clarity, I need more visibility, I need a little more security. And your risk is that you pay more. But the flip side of that coin is that you don't end up holding a stock that loses 50% when the results come out.
Yeah.
There's give and take. And truthfully, what I paid extra on my ShopRites, I'm perfectly happy to, because I'm buying them with more confidence and with less concern. To Aspen in of itself, I mean, they've got challenges. The biggest challenge is debt. They're in breach of their covenants. They need to get their milk formula business sale concluded. New Zealand,
they've delayed.
And New Zealand is the hold-up. The New Zealand authorities haven't yet approved it. I spent hours yesterday reading through, trying to work out, is there some sense of New Zealand not wanting to? Now, certainly from a purely legal perspective, I can't see any problems, and I'm not the expert here, but certainly there's no media reports. The media reports that I have seen seem to think all is well and good. There is, however, a growing concern amongst New Zealanders, and I know that we've been down this route as a country, of foreigners buying their companies. Now, truthfully, the milk business is owned by Aspen, who's already foreign.
Yeah, so it's a bit late.
Yes, but now the French, and maybe they would like a New Zealander to buy it instead. Whether that scuppers a deal, I'm not sure. But even if that goes through, their debt will drop from about 54 to about 44 billion. They won't be in breach of their debt covenants anymore. The bankers have given them an extension, but the market is spooked. The market is very spooked by that. If this deal doesn't go through, they need to do a very rushed rights issue. If the deal does go through, their debt is still sort of 1-to-1 in terms of market cap, and they need to get it down. And rather than fire sales, I mean, is there a rights issue coming here? The core business and results in of itself, they're doing okay, but they're not the high growth business they once were. They should be sitting on a PE of around about 10. That's about a fair PE for them at this point in the equation. But they need to manage their debt. And the last point is, if you read the Buffett Berkshire Hathaway letter, which came out a few weekends ago, his letter to the shareholders, his annual letter to the shareholders, which is always worth the read, berkshirehathaway.com. Ugly website out of the 60s. And I know there weren't websites in the 60s, but if they were, they would look like this.
Like that.
But he makes a point around debt, and he says, you know what, debt is brilliant. Debt enables you to leverage, it enables you to buy things you can't afford, etc. And obviously he's talking companies, but this applies to, but it applies to individuals too. He says debt is fine until it's not. And he uses the Russian roulette analogy. You can play Russian roulette 100 times and everything is fine. But one day, one time, it's not fine, and then it's game over.
Yeah.
And we're seeing a number of companies on our market at this point in time. Tongaat, who've got other issues, but debt is one of them. Blue Label, other issues, but debt is one of them. And Aspen, and many others, to whom, in the boom go-go days, debt is fine. But eventually it comes back. And I think the broader lesson from this is to watch debt levels. And yes, management will talk a great talk, but understand when it all goes pear-shaped, they exit, they've got their bonuses, they move on to the next job. We're the shareholders. We're left carrying those eventually debt. So the question is, does debt always eventually go wrong? And the answer is probably no. But certainly the answer is it goes wrong often enough to be very scared of it.
Okay, and perhaps lastly, just touching on the banks. Again, lots of the reports coming through, but actually even Liberty, South Africa operations looking slightly better, but results and earnings still very disappointing. Particularly Africa, just disappointing all around. I mean, the Liberty story is one that I've followed for a while, and every time I'm like, maybe this is it. It just doesn't get better. It just doesn't get better. So, with the Liberty story, do you think there's any hope, with obviously the knowledge as well that we're in an environment where consumers are under pressure? It doesn't look rosy anyway.
Yeah.
Where to from here?
So all you can do in this space, because who's buying policy these days? There's no new customers coming through. So you're basically trying to steal market
Other
share
people's.
from your competitors, and make no bones, they're trying to steal yours. And net it's probably more or less a flat game. The other point is that they make money off rising markets because of their float, so they're getting squeezed on both sides. All you can really do in an environment like this is manage costs. And I do agree, there certainly was some glimmers that maybe the Liberty turnaround is starting to happen. It's got a way to go, and if we have a boom market and we do 15% this year and 15% next, Liberty will fire and all will be forgotten, and you bring a consumer back into the equation and they'll be off to the races. Except that, of course, that the industry is changing. The staple retirement annuity with 6% fee is gone. 1%, 10x do 1%, and now people are saying, hang on, but so-and-so is doing 0.5%, and suddenly 1%. Yeah, it's that race to zero, which as a consumer you love, but as a product provider, you can't go to zero. But broadly, I think our financial institutions, and if we bring the Liberties and the Momentums into it, and the banks, etc., they've held very well. They haven't done spectacular in the asset management space, but they've held on, and that's the market hasn't helped them. Coronations at multi-year lows, etc. Anchors back at where it listed, etc. Signia just above listing price. It's a very, very tough space because squeezed consumer, no market performance.
Yeah.
But what we are seeing in these spaces is some companies that are really solid companies that have survived, that are well positioned, and that when things improve, are well positioned for that improvement. And we've seen from the banks, and most notably, if we look at Standard Bank and ABSA, and to a lesser degree Nedbank, considering good results.
Yeah.
Imagine that in an economy where we're seeing 3% growth. Imagine that in an economy where the consumer is actually confident and rich enough to spend. And able to get loans, because obviously the National Credit Regulator makes it harder. Suddenly, those low single-digit percentage headline earnings per growth very suddenly becomes 10, 12, 14, maybe even 15%. And then the shares, as they're priced right now, are exceedingly cheap. And what we saw, the year started with the banks going absolutely crazy in January. They've pulled back markedly as some reality sets in. But unless you're saying, look, it's 5 years before we see any improvement in GDP or consumer confidence, if we can do it in the next year or two, and it's not going to be easy, and it's not certain, and it might not be 3%, it might just be 2% GDP, these institutions are incredibly well positioned for it. Some more than others. In the asset management, Coronation's my pick. We've talked about it before.
Yes.
The 10% yield. In the general banking space, I love Capitec, but they're expensive. Then it's either ABSA for the recovery, but it's probably Standard Bank, maybe First National. They're not going to make you money in a hurry, but they're going to pay you dividends in the meantime, and they're incredibly well positioned with strong capacity, balance sheets, and management teams.
All right, and perhaps let's round off or end up with the rand, which apparently, so a lot has been happening. A couple of days ago, our president spooked the market by declaring that they would forge ahead with nationalization, which has caused
Did he spook the market, or did he spook Twitter?
Well,
because perfectly, that was a policy taken at Nasrec. That is a policy that he has stuck by. And yes, at Davos he seemed to say something contradictory, but at Davos he said the Reserve Bank will remain independent.
Not necessarily.
On Thursday he said we will nationalize it. Those two are not
the same.
You can nationalize. The independence doesn't come from the shareholders. There are 750 Reserve Bank shareholders. If that is what is keeping our economy on the straight and narrow, frankly, that is a fundamentally scary thing. I'd rather have 400 parliamentarians than 750 anonymous people managing it, because maybe it's 750 people who front for the Guptas. We don't know. So, I mean, and Twitter went crazy, and most of it was with ill-informed ignorance, but nonetheless. So the rand has been slightly worse than its emerging market peers.
Yes, yeah. So, and this is the thing, right? Because a lot of people then rushed and said it's because of this. But if you'd actually kept track, even in February, the rand was the worst performing emerging market currency. So we've seen quite a lot of pressure for the rand.
We are certainly seeing pressure on EM currencies globally that ebbs and flows, but there has been recently a movement to dollar and euros and out of the emerging markets. We did get hit worse. Our currency went out to 14.40 on Friday. It was looking a bit better earlier today. But remember what our currency is. It's our randella. We love it. We're patriotic towards it and the like, even if it doesn't buy us much when we travel. But as a trader sitting somewhere, and whether you're sitting in New York or Amsterdam or wherever, it doesn't matter. If you want to trade EM currencies, you can trade the lira, but it struggles from legislation and liquidity problems. Ditto with Russia, ditto with the real, etc. The one Mexican peso is nice to trade, but the one to trade is the ZAR. So you think that EMs are going to be in trouble for whatever reason, and EM currencies are going to weaken. You don't trade a basket of EM currencies, you just hit the ZAR, because we're the most liquid of the EM. So we typically, therefore, overshoot on both directions, because we're an EM proxy, which makes our currency significantly more volatile. And I've got a lazy trading system, and someone said to me, why don't I trade it using currencies? Because I trade ETFs on it, and there's some currency ETNs. And the answer is quite simple. Our rand's just too volatile. If you do it in the majors, it works beautiful, dollar, euro, that sort of thing. But on the ZAR cross to anything, sterling, euro, yen, dollar, it's just immensely volatile. And sometimes it will be politicians or the like, Eskom putting their foot in it, that hits us. But oftentimes it'll just be a general move on EMs, and we're the outlier because we're the easy one to trade in volume.
And final thought. 29th of March, we've got an update from Moody's. What are your thoughts? Which direction do you think they're going to take?
I think they'll keep us where we are. Two reasons for that. Moody's are generally quite unmoody and quite relaxed and give you a lot of rope, and they're always the ones that you could argue are far behind the curve, but it's their methodology. I think we've done probably enough. I think the budget from Tito Mboweni, which was a very hard budget in both senses, hard for South Africans, but hard to put together, and I think he walked the line, and respectfully, and I think there are few people in our country who could have walked it as well as he did. I think we are fortunate to have him. I'm not in any way dismissing Nklanhlanene, who was supposed to have delivered it, but he did a good job there. We're putting some things together. What's coming out of places like Zondo and the other commissions are terrifying as South Africans, but shine a light on it. That's
least
critically important.
They're coming out.
Yeah, I think that's very, very important. So, and Standard & Poor's, Dow Jones, Standard & Poor's, S&P Global, as they call themselves, actually upgraded Eskom debt. That was before NERSA only gave them 9.4.
Yeah.
But my sense is that we've probably bottomed unless something really, really bad happens. And load shedding is not something really, really bad. And nationalizing the Reserve Bank is not something really, really bad. Firing your cabinet and replacing the finance minister with one of the Gupta's nieces, that's really, really bad. I think we're probably going to pass it, and I think we're going to survive. We mustn't for a second kid ourselves, as we have come immensely close to full junk status,
yes,
which would have been a first since we dug our way out. Obviously in the 80s we were in junk, new administration in the 90s, Trevor Manuel and others slowly dug us out of that process, and we very, very nearly went back into it. It's not the end of the world, but it's the last place you want to be.
Yep. All right, Simon, thank you very much for your time. As always, very insightful, and glad you're alive.
I'm fit and healthy.
And we'll chat next month.